All attendees are in listen-only mode.
Good afternoon, everyone. Thank you so much for joining our webinar today, Family Ties, Unknotting Controlled Group Attributions. My name is Amanda, and I'll be your moderator, and ERISA attorney Larry Gugine is our presenter. This is a pretty complicated topic, so don't worry if you miss anything. I know we have a lot of charts in here and some examples, so we'll be emailing the slides and the recording of this presentation to everybody after the webinar concludes. I'm going to keep everybody muted during the webinar to avoid any background noise, but Larry will pause periodically for questions. You can just type it in the question box below and I'll read it aloud for you and get you your answer. Our next webinar is in 2 weeks and at 1 p.m. Central again, and we'll be covering any healthcare updates under the new administration since the last time we had one of those webinars. But for now, I'm going to turn the presentation over to Larry.
Amanda, thank you very much. This area is extremely important, both on the benefit side and the corporate side. And what I want to try to explain today, how it works, why it's important, and the reason I wanted to do this, because one aspect which I'll be discussing today is the aspect of what's called multiple employer welfare arrangements, or MWAs. And every so often I run into this, and it's something that you want to try to avoid because there's extra liability and also reporting, and it's something I'm going to explain what it is, why it's important. But this area, especially if your employer or if your clients do a lot of mergers and acquisitions, buying things, setting up things, this is one area you have to get your hands around because it affects all the non-discrimination. It affects all kinds of qualification issues, both on the retirement side and on the health and welfare side. So let's start going through this so we can basically understand how this works. So first of all, I'll be covering what I call common control terminology. I'll be talking about some of the terms I'll be using over and over again. Then I'll be talking about the parent sub control groups, the brother-sister control groups, and then I'll be talking about what we call the MWA risk, what happens. And again, that's one area I want to emphasize and why it is an important area. Then I'll be talking about an affiliated service group rules, and then lastly, additional considerations, issues that you have to consider. Now, the reason why control group rules are extremely important is because if it's determined that with other businesses you have common ownership, then for all testing purposes and for all non-discrimination issues, basically the IRS and DOL treats these different companies as one employer. It doesn't matter if you have separate EINs, it's all based on ownership. So what really it started to emphasize this is Affordable Care Act. Rules consider the employer to include related entities. You have such terms as applicable large employer, and in the determination of whether you are subject to the rules, subject to the employer mandate, we consider this on a control group basis, and that's where I think everybody started really looking at this in more detail, because many times an employer would be very close and they would have to look and see what ownership interest they had in other companies. So to determine the employer size to identify if it's a large or small employer. So it impacts also the eligibility for small business exchanges, the SHOP, impacts the applicability of small group market restrictions. And again, if you are considered to be a control group, then you are considered to be one employer. And also eligibility for small business health insurance tax credit, Cadillac tax computations. And also, and this is really important, the annual ACA reporting under forms 1094, 1095. So in those forms at 1094 and 1095, they use the term aggregated LE group, and that's another term for control group. So that's what they're referring. So you'll see different terms covering the same area. So the same ACA employer aggregation rules are used other places in the Internal Revenue Code. ACA non-discrimination testing under 105H, cafeteria plan non-discrimination rules under 125, group term life insurance. So, and because of the fact that it's treated as one employer, which you have to do, and when you look at these tests, you have to determine whether an individual is a highly compensated or non-highly compensated, and those individuals are determined on the control group. Now, there's a misnomer on with many of these tests that you have to give the same benefit to all individuals. And that's not true. You have to include enough lower paid people to pass these tests. But again, who is highly compensated and not highly compensated is going to be determined on a control group basis. We also, in dependent care non-discrimination, fringe benefit, and other non-discrimination rules, but also we also look at it for qualified retirement plan rules. Because remember, because you're determining highly compensated and non-highly compensated, if you don't consider all the individuals working for that one employer, then all your non-discrimination testing is incorrect. Because everyone who is working for the company has to be considered in determining who's eligible. Now, these rules are found in code sections 414B, C, and M, O, and T. So that's where you find. So these are IRS rules. And there's a really good explanation, a very detailed explanation on the web that's put up on the IRS, but it's like 146 pages long. But it has great examples. I think if you want to dig a little deeper on that, just go on the web and put it in control group rules IRS and you'll find it. So the terminology, which is real important, you'll see the term control group of corporations, trades or business under common control. You'll see affiliated service group and aggregated ALA group. And it doesn't matter, I mean, these are all referring to control groups. So again, there's various terms that say the same thing. And you could have separate EINs, it doesn't matter, and many employers do. You could have a control group and have a number of different EINs. EINs have nothing to do with this determination. It is all, as I said before, it's all based on ownership of the partnership, business, or corporation. And for many purposes, separate EINs really have no determination on whether they're separate employers. It's all based on ownership. Now, if you have under 1094 and 1095 reporting, just remember that people have just gotten done with this. Separate EINs will require a separate report. Because what's interesting about the employer mandate, it applies to each separate division of an employer. So yes, the aggregated employer group is, that's how you determine whether you are a control group and whether you're subject to the rules. But in compliance with ACA, a different approach is taken where each separate employer has to comply, and that's a division in the division has to comply with ACA. So these aggregated employer group rules are very complex. Sometimes it's very difficult to identify who is in a control group, who is not. You could have multiple family or friends sharing ownership, family members, diverse businesses independently owned. And that's why many small businesses get into trouble, because in some different industry lines, for example, hotels and restaurants and various retail, every separate restaurant location could be a separate ownership group, investment group. And for ease of convenience, they may combine all the restaurants into one medical plan or one retirement plan. And again, if you dig deeper and look at this, you find out that none of the control group rules will apply, and these are all separate employers. So learn their red flags, which yellow flags, I'm sorry, which suggest a closer look, especially it's extremely complicated. Many times employers send ownership groupings to me, and I can determine when the control group rules do or do not apply, and that will determine how group insurance is actually written, how it's organized, how it's reported. So this is extremely important, especially if you're forming various investment groups. You have to look at this very carefully. And why it's important, especially if as businesses get larger and larger, and all of a sudden, and they are turning, especially for medical benefits or dental benefits, into self-insurance. The problem is if you have unrelated employers participating in your plan, many states, including Illinois, prohibit what's called self-insured MIWAs. So you have to look at this very carefully. And again, you have to be, and if there's a doubt, get expert assistance, get your attorney, get your accountant, your business advisor, and look at this, especially because many times when we're dealing with mergers and acquisitions, benefits are the last thing people look at, and sometimes it could scuttle a deal. So look at the first one. It's called parent sub, and this is subsidiary. This is pretty easy to look at. Basically, the general test is that the parent company owns at least 80% of one or more companies in the group. And again, you have to look and see the individuals who own the parent company. Do they own 80% of each of the companies that you see here? Company B and Company C are subsidiaries of Company A, and in this situation, Company A owns 80% of Company B, and then 80% of Company C. In that situation, that would be a control group. For all intents and purposes, this would be considered to be one company. And again, each of the companies involved here each one of them could have a separate EIN number. Because Company A owns at least 80% of Company B and C, now A, B, and C are all considered to be part of the same control group. Here in this situation, you could have various, and you have to look at this, tiers of ownership. And you look on the right of the slide, you have Company A, parent, owns 80% of Company B, but Company B owns 100% of Company C. And that situation, that again is a control group, and therefore it would be, again, considered to be one company. So expanding the parent sub-control group include entities directly owned 80% by one or more other entities in the group. And the shaded entities are the added entities. So in this situation, Company A owns 80% of Company B and 80% of Company C, but Company B only owns 40%, and Company C owns 40%. Now in this situation, you say, wait a minute, this is a control group. And it is because in this situation, combined, because B and C are in the same company. So combined here, Company A owns 80% because B and C do of Company D. So you have to be very careful when you look at this, who owns what, and especially on the left, Company A is in the control group with Company D because combining B's and C's ownership, they own 80%. On the right here, we have parent Company A owns 80% of Company B, and then also B owns 80% of Company C. In that situation, as we did in the prior example, this would be part of a control group. So here the red flag is when you look at this, and again, as I indicated before, all this is based on ownership. One company directly owns at least 80% of another company. So you have to look at the various tiers to find out exactly how much Company A owns of each of these companies B and C, and see if there are owned by the ownership rises to, the common ownership rises to 80%. So when we look at ownership, and this is what everything is based on here, for corporations, it's both based on voting power of all classes of stock or value of classes of stock. With partnership, it's profits interest or capital interest. So sole proprietorship, the proprietor is the legal owner. In regard to trusts or estates, it's the actuarial interest of the grantor, beneficiaries, or heirs. Who has the ownership interest in the trust or the estate? That's what you have to look at. And generally, it's the beneficiaries, especially if it's irrevocable. In other words, the grantor of the trust, the person who set it up, cannot take it back. And there's certain exclusions for treasury stock and other situation. For example, a subsidiary stock held by an officer of a parent company that already owns 50% of the subsidy would be considered to be an owner. And more and more I see limited liability companies. It will depend on how it's organized. Is it organized as a partnership like an S Corp, or is it organized like a C Corp? Do they pay separate taxes, or does all the assets and liabilities flow through to the owners? So in regard to an S Corp, for example, the S Corp doesn't pay taxes, but it's all the assets and all the income and deduction flow down to the owners. So in that situation, you have to look and see how it's taxed and follow the ownership rules. Tax-exempt organizations, it's different, because with tax-exempt organizations, there's no stock, there's no ownership, and basically what we look at here is that it's based on whether at least 80% of the directors or trustees are either representatives or directly or indirectly controlled by another organization. So it's now in this situation, it's control. Who controls the operation? And if you have one organization running another organization, and they have 80% of the trustees or directors involved in that, then that would be seen as one organization owning another. So it's based on significant facts and circumstances, control an agent, permitted aggregation, regularly coordinated daily exempt activity, and do they coordinate things together? So if you have trustees or directors in both organizations that are similar, the best bet is that these two organizations are controlled and would be considered to be one for tax purposes. Church-controlled organizations are excluded from these regulations. There's special rules on that. Now, what's interesting, and I run into this every so often with public sector employers, and this has been going on for years, is the reasonable good faith interpretation of the regulations. So again, it's open season. We don't know what the government's going to do. This has been like this for years. So again, you can use any reasonable interpretation, and I basically tell people when you're dealing with private sector employers, do they have a separate budget? If you look at who controls the various sectors of the government, does one organization control another? That's what you have to look at. So there's a number of factors you have to look at, and does one part of the government really run the other part of the government? And that's what you have to look at. And again, it's not separate EINs. This next one is probably more common. And what we call it is the brother-sister control group structure. And basically what it is, there's two tests. There's a general test. Do 5 or fewer individuals, estates, trusts together own, or directly or by attribution, at least 80% of each of the other organizations. So here we have 2 organizations. John Smith owns 25% of Restaurant A. Then he owns 15% of Restaurant B. Jim's Family Trust owns 30% of Restaurant A. they also own 50% of restaurant B, and then Mary Smart owns 15% of restaurant A and 20% of restaurant B. This is very common. You could have a number of different individuals, but again, what we have to look at, do 5 or fewer individuals, estates or trusts together, own at least 80% of each of the organizations. That's what you have to look at. So you have 2 tests basically. You have the general control test, where at least 80% control by 5 or fewer, and then you have to meet what's called the effective control test. You have to look at the common ownership in each organization, and you take the lowest number that they own in each organization, and in this, it must exceed 50%. So if an individual owns 15% in one and 20% in another, what's common in that situation is 15%, and that's what you use for the second test. So in this situation, you have to pass both tests. I'll have some examples how that works. So here, the effective control, under the effective control test, concerning only the smallest percentage of each of the 5 or fewer that owns each company, any company. So in this situation, Jim owns 25% of restaurant A, and then restaurant B, he owns 15%, so we use 15% as a common ownership. And the family trust, he owns, Jim's family trust owns 40% in one, 50% in the other. And here, the common between the two would be 40%. That's the lowest figure. So that's what you have to consider. And again, I have some examples in regard to this. So here we have a situation. We have corporation A, B, C, and D. So in this situation, Craig owns 100% of corporation A. He owns 20% of company B, 40% of company C, and 51% of company D. Judy owns 0% in A, 20% in B, 20% in C, and in D she owns 0. Brian owns 0 in company A, 20% company B, 10%, 9%. And then Elizabeth owns 20% of B, 10% of C, and 20%. And then Ray owns 20% of B, 20% of C, and owns 20% of D. Now, in this situation, again, what we have to look at first of all, the first test, the general test here. Do 5 or fewer individuals own at least 80% of different organizations? So we look at let's look at companies B and C. And in this situation, we have 1, 2, 3, 4, 5. So in this situation, 5 or fewer own at least 80%. So companies B and C would be considered to be, they meet the first test. Now looking at the common ownership, does it meet 50%? So here Craig owns 20 and 40, so he owns 20 there, 20 there. Brian owns 10, 20 and 10, so it would be 10. Elizabeth owns 20 and 10, it would be 10. So Ray owns 20 and 20, so it would be 20. So in this situation, it would be 20, 40, 60, 80. So again, clearly, B and C would be part of a control group, very clearly. Now, A would not be because, again, it's owned just by Craig. Let's look next at D. All right. Here, do 5 or fewer individuals own at least 80%? So we look at B and C and D. So in this situation, let's see here. So it would be 51/9, which is 60. So in this situation, D would meet the 80% test because the same 5 or fewer that own B and C also own D. Let's see if in this situation, let's look at C and D. Here, Craig owns, it'd be 40, 9, 10, and 20. So clearly, C and D would be considered part of the same control group. Would there be a control group with B? Here, we look at B and D. So it would be 1, 2, 3, 4. Yeah, they own, again, they own, so again, Corporation D, Corporation C and B would be all considered to be a control group. Now, what's important to understand, there's also attribution. To and from parents, children, grandparents, to and from spouses, including same-sex spouses, to grantors and beneficiaries of trust, to beneficiaries of trust, and from companies to individuals that own 5%. So you have to also look at the family relationships in the various organizations. So let's look at family attribution. First of all, to and from parents. There is an absolute attribution between a parent and child if the child is under age 21. So when you're doing the calculation, especially when you're asking about the individuals, you have to ask about what the family relationship is between the individuals. If the child is 21 or older, then the parent is deemed to own the child's share only if the parent already owns or is deemed to own at least 50% of the company. If the child is deemed to own the parent share only if the child owns and deemed to own more than 50% of the company. So there's attribution back and forth depending on who owns 50%. And then family businesses, again, this is extremely important because you have to look at the various family members to see if there's attribution between the family members. At the bottom of page 18, there's an example. Kelsey owns 1/3 of a corporation A. Nicole, Kelsey's 19-year-old child, owns 1/3. And Will, Casey's 25-year-old child, owns 1/3. So in this situation, again, Nicole's share is automatically attributable to Casey. So now she's at 2/3, which is 66. And because she owns more than 50%, she's deemed to own the entire corporation. So these how this this situation works. There's also attribution to and from grandparents and grandchildren. Grandparents to grandchildren only if the grandchild owns more than 50% of the business. Grandchildren to grandparents only if the grandparent owns 50%. And please remember, between siblings, brothers and sisters, there's no attribution at all. So again, this is extremely to look at and ask if family members own part of the business. Now where it gets tricky is with spouses. A spouse will be deemed as owning interest in the other spouses unless these conditions are satisfied. Each spouse has no interest in the other's business. Neither spouse is a director or an employee or manager of the other business. not more than 50% of the business entity's gross income is derived from royalties, rents, dividends, or interest, and the spouse that owns the business can dispose of the stock at any time without restrictions. So if you have two individuals that own businesses and they're married, but they're not involved at all in either of their businesses, then there would be no attribution between the spouses. So Kelsey and Dennis are married. So in this situation, the question is, we don't know at this point how involved Casey and Dennis are with their other each other's business. And here, if they're not involved with each other, then they would not be, there would be no attribution. If they are involved in their businesses, then Casey and Dennis would be treated as one individual. And they would be treated as, for example, if Dennis was involved in Casey's business, then he would be deemed to own 100% of Company A. So again, it's extremely important to ask how involved each spouse is with the other, because it would affect, if you look at slide 21, about how this is basically deemed, because if Casey and Dennis are considered to be one individual, that changes the dynamic of any testing. To grantors and beneficiaries of trust, and basically here, whether or not it's a grantor trust, the beneficiaries of the trust are deemed to have a pro rata interest in the property of the trust. So if an individual family member has, for example, a 20% interest in the trust, they are deemed to own that portion of the trust. Attribution from an estate of beneficiary in the estate that owns stock is considered to be owned a proportional share of stock. Attribution to an estate, stock owned by a beneficiary in the estate, is considered to be owned by the estate. So a consulting firm, is A and C a control group? Let's stop right here. Amanda, I've been going on and on. Do we have any questions?
We do have two. The first is, would an investor who purchases majority stakes in portfolio companies be considered a control group?
Majority is only 50%. It has to be 80%.
Okay. So as long as they purchased under 80%, no.
Right. And again, who they purchase it with. If they purchase it with a family member, you have to decide who that family member is, because if they purchase 50, but their child or grandchild owns the other part, bingo, you're there.
Yeah. And then, are franchises that are independently owned considered control groups, entities such as big fitness club chains and fast food chains?
Well, what's basically in that situation, it depends. It all depends who owns the business, because in this situation, many of the franchisees are independent businesses. And it all depends, again, who owns each restaurant. What I found, especially in various restaurants, each restaurant could be owned by a different investor group. So that they could be a separate corporation. They could be operating one of the fast food chains, but each restaurant could be a separate business, because each restaurant doesn't have, their common ownership doesn't rise to 80%. And that's when individuals can get into real trouble.
All right, if you have any other questions, please leave them in the question box below. We'll pause for a couple more seconds.
So in this situation, you're a consulting company A, are A and C a control group? Well, here, James Jones owns 100% of Company A. Jim Jones owns 30% outright of Company C, but Company A owns 50% of Company C. And in this situation, they would be a control group because they have common ownership of at least 80%. So again, you have to ask of the various companies who owns what, and you have to ask, okay, company A owns 50% of company C, but who owns, and I always ask this question, who owns company A? Then you have to dig a little deeper and dig a little deeper in determining the ownership of various organizations. So in this situation, here's one example where I have the answers already there. We have, it's a brother-sister group. You have owner A, B, C, and D own restaurant 1, and there's various percentages. Now, in this situation, again, you have to do the 2 tests. Do 5 or fewer own 80%? So you have to look at this. Here, A, B, C, and D, that's 60. It goes to 85. Here, restaurant 2 is 100%. So clearly 1 and 2 are control group. We look at company 3. The common ownership is again with A, B, and C, it's only 60%. With A, B, C, and D, it's 100%. So here, control group A is companies 1 and 2, but control group B is 1 and 3. And this happens many times where you have companies you think are related, but they're only related to one of the entities. And you have to look at this effective control. We look at 1, 2, 2 and 3, 1 and 3, and all 3. And again, this is where you have to meet both tests. So again, on the first test, it's 1 and 2, and then control group, effective control 3. Now, combined benefit structures, what's very important here is that various structures, John owns 30% of A, B, and C. A trust owns 35% of A, B, and C. Amanda, can you hear me?
Yes, I can.
Okay, I'm getting some background noise, so I apologize for that. So many times you have what's called combined group rules. 2-part test. Each member of either a parent subsidy or a brother-sister group, and basically what this slide demonstrates the fact that John owns 30% of A, B, and C, Trust owns 35% of A, B, and C, and Mary owns 30% of A, B, and C. Basically, you have 3 parent companies, A, B, and C, and in this situation, company D is a subsidiary, and then E is again a subsidiary. So in this situation, you would have a control group. Now, when you're looking at this, and a real issue and problem is going to be here, multiple employer welfare arrangements, or MEWAs. Here, health plans covering 2 or more employers. And what we're talking about, 2 or more employers that are not considered to be part of the same control group. Now, what happens in this situation, this is extremely important to understand, is that state insurance rules may regulate and may prohibit self-insured MEWAs, and state mandates may apply because they may treat the MEWA as being an insurance company. So again, ERISA, ACA, and other complications in that. You may have to file, for example, there's no, you may have to file a 5500. You may have a form called an M1 that you have to file, which is extremely complicated. In some states, as I indicated before, Illinois does prohibit self-insured MEWAs, and in some states like California, even if insured, you may be prohibited because of the fact that only associations. So again, if you have a company that has unrelated employers operating in this situation, if you have unrelated employers, you have a MEWA, and you have to look at each state that you're operating. That's the problem, and it creeps up many times with restaurants and hotels with various investment groups. That's what you have to look at. Now another type of control group is called an affiliated service group. And basically what we have here is service organizations servicing each other. So two or more companies with at least one service organization that should be considered to be one employer operationally. Focus is operational relationships, not so much ownership, rendering services to members within the group, and jointly rendering services to third parties. This only applies to professional organizations and consulting firms. The service organization is the entity, the principal business to which the performance of services, for example, engineering and healthcare professionals, as distinguished from one deserving from a majority of revenue. So it's what services they are performing. Now, you have various types of affiliated service groups. You have a we call an A organization, which is a first service organization and at least one A organization. And then you have a B organization, which is a first organization and at least a B organization. I will be explaining each one. And then you have a management group, management organization and one or more entity that they're performing management services. Now let's look at the management organization. Here we have a principal business of the management company is providing management services on a regular and continuing basis. And example 2, same as example 1, but A services A, B, and C, which are related. In this situation, to be part of a control group, that management has to provide at least more than 50% of the service to one organization. Here, in this example, management services A, B, and C are all related. Even though there's no common ownership between the two, they would be considered to be part of the same control group. So if the management company is providing management services to A, B, and C, and that's the majority of their income, they would be considered to be part of the control group. So here with Management Service Corporation, you have two organizations, one performs management functions. Principal business management organization is performing management function on a regular basis to a recipient organization. No need for overlapping ownership. Management functions examples running daily business organizations, personnel decisions, setting up compensation of benefits, or setting goals. So here is the management service group example. A landscape company and the maintenance company splits into two companies. One company, W, was established to employ the workers. M was established to employ management and design team. M performs management services for W, and W is the only client of M. W and M would be considered to be an affiliated service group. The next example, we have an A org and a first organization. It's a medical clinic regularly performing services associated with a medical staffing company. So we have a medical staffing company services clients for the medical clinic. So in this situation, Clinic X is a shareholder, a partnership, and regional staffing company. Both the A org and the first organization are service organizations. If the first service organization is incorporated, it must be a professional service corporation. So this is, again, doing something to really circumvent professional people from setting up organizations and, for example, having nurses in one corporation and they and another corporation and providing different benefits. So an A org and a first organization must be a service organization. Capital is not a material income producing factor. You look at the facts and circumstances, and organizations in the following field are deemed to be a service organization: accounting, architecture, engineering, insurance, performance arts, actuarial science, consulting, health, law, and I did consulting twice there, but again, you can look and see the fact that these are professional people. So again, requires an FS, a first service organization, an A org. An A org is a service organization, is ownership in the first organization, and regularly performs services for the first organization. So Dr. Smith owns 100% of the medical corporation. Her corporation is 50% partner in Smith and Wesson Clinic, a partnership. Her corporation provides medical services to the partnership, which in turn provides medical services to the public. Both her corporation and the partnership are service organizations. The clinic is the first service organization, and her corporation is an A org. They would be considered to be a service organization. The other structure is what's called a B org and a first organization. Here, a financial service company is a financial services firm. A significant portion of Support Inc.'s B org business is providing services to the first organization, which is historically performed by employees in that business. One or more of the highly compensated of SSFS together own at least 10%. Here, this is considered to be a B org and first service organization. What this requires is a first service organization and a B org. A B org has a significant portion of its business in the performance of services. Services are historically performed by the employees, and a 10% ownership requirement is met. Jack and Jill are attorneys. Each his or her own a law corporation, and the two corporations own 100% of J&J Industries. Bear with me 1 second. Okay. Jack and Jill's corporations are A orgs. J&J LLP is a first organization, and the three organizations together are a affiliated service group. So again, when you're dealing with professionals, this is very common. Attribution: grandparents, there's no attribution. Siblings, there's no attribution. Shareholder: the C Corp shareholder owns at least 50% of the corporation. Partners to partnership, attribution of partner's interest, and beneficiaries to a trust, again, attributable to the beneficiary's interest. So transferring ownership to avoid control group grooves. So there's something called a predecessor company that would be combined. Carriers have differed in how carefully they examine control groups. Many don't. ACA has resulted in more carrier interest, and different members of a control affiliate group can have different benefits. But again, you have to be careful that you cover enough lower paid people. So whether you're looking for confirmation or a simple situation, what you have to look at is look at ownership details, percentage of ownership, look at relationship among owners or between entities and owners. Service organizations, are they tied to another organization? And you're dealing with entities' tax status. If they're not-for-profit, what you have to look at is who controls the organization. Is it controlled by another organization? That's what you have to look at. Amanda, are there any questions?
I don't have any at the moment. Again, you can type your questions in the question box below and I can ask Larry. But otherwise, thank you guys so much for joining us. We'll be back in 2 weeks at 1 p.m. Central to cover updates in healthcare, since the last time we had a healthcare update webinar, and we hope to see you there.
All right. Thank you very much.
Thank you.